Welcome back to the channel. I'm Dee from the Market Stalkers team. When I first started trading about 15 years ago, I was actually a session musician. In fact, when I announced to my immediate family that I started trading, my own mother laughed in my face. Now, you may think, oh, that's not very supportive, but actually if you know that I excelled in every subject apart from maths, you may forgive her for using these past events as her guide, whether I would be a good trader or not. Luckily, it turned out that I was very good at maths, except when I was young, my interests were elsewhere. But once my interests aligned with me needing maths to do things like coding and statistics, my IQ of 140 came out to play. But just like any other regular person coming from a non-financial background, I actually had no concept of risk management. I mean, I'd heard the term risk management, but I didn't fully understand what it actually entailed. Why you would want to have any loss limits at all if you're trying to make money. Everyone comes into this with dollars in their eyes to some degree, but that really cannot be your only motivation to survive, get better, and eventually thrive as an intraday trader. One strength that I always had was a very natural analytical side to me in everything that I did, including music, which is why I can play 4 different instruments to a very high skill level. So eventually that kind of an approach, the methodical approach, found its way into my trading style too, that I now teach others. And right now, in the wake of all online prop firms, especially in the futures trading space, are going down the path of minimal rules, no real daily loss limits, just kind of an overall drawdown, I feel the need to reiterate why you need to have your own personal daily loss limit. For the first 5 years of my own trading journey, I was actually an independent swing trader. So a daily loss limit wasn't actually something that I needed. But once I got into prop trading in 2013, I was introduced to the daily loss limit and also a whole host of other performance metrics. And they were pretty tight, especially considering that back then, we didn't have micro futures. So to give you an idea of how difficult it used to be, they gave you a $225 daily loss limit to start with, and you had to trade pretty much full contracts or E-minis. Now, that daily loss limit wouldn't even cover one trade for a 30-tick stop loss, which is what I use to this day. So you would blow your limit trying to trade one trade per day, and subsequently you would lose access to the account for at least the next 7 days. So why is the daily loss limit important? Some people see it as hindrance. Some people see the maximum drawdown as a hindrance. They want, I don't know, unlimited money for nothing, I guess. But to this day, whenever I'm doing performance coaching with traders, there is always a limit to how many trades you can lose in one day. Now, this is important for several reasons. First, it prevents you from digging a pretty deep hole in one day when things are not really going to plan, when you're not reading the market well. Inexperienced traders have a hard time controlling themselves, and especially when the market doesn't do what they expected it to do. And again, there are a number of reasons for this. One of the major ones is lack of confidence, but also lack of knowledge, which goes hand in hand with lack of confidence. You don't really understand the probability of the setup that you're doing. All of this means a lot more uncertainty in your head, so more chance of losing control. Because deep down, you're actually afraid of the unknown, which in turn kicks off your fight or flight response. It's a funny thing. The second reason why you want to have a daily loss limit is for budgeting purposes. If you've had a trade that reached its full target, and let's say that target is twice what you've risked initially. So if you risk $100, your target is $200. So if you've already won a trade with full target, and then you trade again and again, and both of those trades lose, you give back all of the money that you've made. That is not the object of the game. If you've made money, you need to keep the money. So we need some risk controls to ensure that if you've already made the money for the day, that you're not giving it all back. Having a good loss limit, it also ensures that your losses will always be similar. Everything relating to the risk model components, because neither of them are an isolated thing, it has to be looked at as a fine balance and equilibrium between a whole bunch of components. All of that plays into your risk model. So as soon as you start changing things, position size, stop loss size, target size, it breeds inconsistency, and then it gets very, very difficult to gain any headway. You'll always be like 2 steps forward, 3 steps back, and you're slowly kind of bleeding the account, not really realizing all the components that you need to have in place. And that is something you really want to avoid. In any other business, if you've made 200 profit on the day, you wouldn't then go out the same day, spend all of it and then some on new stock, money that you don't have. So some respect to yourself and the work that has gone into this profit generation today needs to come into consideration. Finally, having a daily loss limit will force you to seek quality over quantity. Whilst the loss limits that I had when I started out were very tight, it did force me to get very creative with the types of setups that I was taking. If you know that you're only allowed 1 trade per day, you're going to make sure that it's a good one. The name of the game is not who can trade the most trades in a single session. And I see these contests and challenges all the time where it's like, oh yeah, leaderboard, blah. But all that happens in those silly contests is that the quicker somebody makes the money, they lose it even quicker. This whole channel is here to show people that trading is not impossible. It can be a serious viable source of income and wealth generation. And again, just the other day, I saw on Twitter someone boasting about 1 day's worth of scalping where they used a 50K account from Apex, which by the way has a general drawdown of about 2.5K. And this person showed 8 trades making $2,500 per trade. What you're looking at when you're looking at a challenge, your maximum drawdown is your initial account size because that's your risk allowance to begin with. Later on, you get more and more leverage, the more profits you generate, that's how you scale up. But you still have to be sensible with your risk. If you're expecting to make 100% of your entire account balance, is that sensible? No, that's trading like a lunatic. One thing that all prop firms have in common is that they will not give you a live account unless you can manage your risk correctly. Okay, this is the reason why a whole bunch of the prop firms today have a lot of people trading on a sim for like a year to prove that you can trade sensibly. And then you get some wingnut on Twitter boasting about making 10 times the amount that the company has assigned you as a risk limit. No awareness of what it means to manage risk within the limits of the account size that you've been given. I have a rule that I teach everyone. Have a look at your performance numbers, your stats. And if you're not tracking stats, I'm not even going to talk to you because there's no point. But for those of my well-behaved market stalkers, what you want to look at is your profit factor. Some platforms will have this as an average win. Others will list it as a risk-reward ratio, but it's all the same thing. All trades won divided by all trades lost. Profit factor is what will show you whether you're really on the way to creating a robust trading approach or whether you're just dicking around with inefficient, amateur, lack of budgeting, and then trying to call yourself a trader. Trading is beautiful. Trading is intellectually stimulating, and it can change your life for the better, but not if you're going to trade like a muppet. So the idea behind looking at your profit factor first is to see whether you're profitable or not. You're looking for a number that goes above 1.3, because that means for every $1 you're making 1.3. Okay? Now with a daily loss limit, in my experience, it's actually best to have a limit on the actual number of trades that you will attempt. I found that if I just gave someone a loose monetary target, they try and mess around with things like stop sizes too much, which in turn leads to those inconsistencies that I mentioned, and then inconsistencies kill their account slowly over time. Intraday trading, in particular, is the highest form of trading skill you can have. And it is extremely sensitive to any inconsistencies. So I like to use an old school video game analogy, 3 trades, and you're out of lives for that day, out of a budget. So 3 trades and game over. If you can't find a profitable trade in 3 attempts, you need to go back to the drawing board, or maybe you need another day when the type of a day that you're looking at is more suitable for the type of trading that you're doing. If it's a momentum trading strategy, you need a day when you will have momentum. Consequently, 56% of the days will not have momentum, but that's again a story for another time. Just like any other business, you need to have a sensible budget in relation to the online prop trading challenge risk allowance. So never mind what the prop firm says about the maximum drawdown, you need to find your own personal drawdown for the day within the thing that they've given you. So if you have 2.5K, you obviously can't use up all the 2.5K in one day, because that's trading like a muppet. So divide that number, the maximum drawdown that they give you, divide that by 5, 6, 7, 10, and that can become your daily loss limit. Final point I'd like to make is that if you're aiming to scale up, you cannot stick to monetary values, and even percentages for that matter, because the futures don't have nano contracts so that you can scale your percentages perfectly. You jump from one contract to 2, 3, 4, and so on. That's why really moving away from monetary values and into tick-based system, you will maintain the scalability as you're growing your account. Why? Because if you stick to monetary values, you will lose the plot very quickly. You scale up for 1 to 2 contracts, that's double the amount of risk, double the amount of target, and what I've seen people do is they scale up, they go from trading 1 contract to 2, and suddenly they're taking profits exactly at the point that they used to make on 1 contract. So now they're not actually looking at a 2-to-1 risk reward, but actually it's a 1-to-1 risk reward. And again, you screw up the whole risk model. But if you focus on ticks, how many ticks is your stop loss? How many ticks is your target? How many ticks do you have for a daily allowance? Everything becomes equal. So it won't really matter whether you're trading a 50K account, 500K account, or 5 million account. The ticks will remain the same. Hope you found this video useful. Make sure to check out the links below in the description box, and don't forget to like and subscribe. As always, let's strive to be less grasshopper and more market stalker with every passing day. Goodbye.